Hi, Leslie Ko here. The US and Iran continue to fight. It seems that there is no end to the war conflict, the military clash between the US and Iran. Even though US President Trump has called the strike, the new strike on Iran to stop, but that doesn't mean that all these attacks from the US has come to an end. It will, I reckon it will return. That means strikes from the US has a high probability that the strike from the US will happen on Iran. And likewise, Iran. Unlikely that it will stay there, do nothing, and continue to be beaten up by the US. It will retaliate. So, all this, I beat you, you attack me, I slap you, I hit you on the face, that kind of stuff now, flip-flop. Create a lot of uncertainties in the market. And that will impact on the, the domestic oil prices. It's very different from the global crude oil prices. As you all know, oil companies is very flexible when it's time to raise the domestic oil prices, like the premium petrol, diesel, so on and so forth, the oil-related products. But when it comes to lowering prices, they are very inflexible. So the domestic oil prices are likely, given the current situations between US and Iran, the closure of the Strait of Hormuz, the domestic oil prices are likely to stay high, and that will lead to continued high inflation risk, and that will keep the central bank maintaining the interest rates at the current level, and likely that they will hike interest rates in the months ahead. Cutting rates, no, it's not going to happen, whether in the US or in Europe or in other places. And high inflations, high interest rates is going to hit the economic growth, the economic engine, or the businesses in this kind of operating environment will have to slow down. People start to be cautious about their spending, and that will influence the sales of the companies, the businesses, and all this will lead to the slowing economic engines. And that will lead to the decrease of oil imports. So the outlook for the demand for oil is going to ease. This is there's no magic or no surprise about this. When the economic engines slows, the demand for crude oil is going to ease, and that will impact the global crude oil prices. So look at the global crude oil prices for this week. The baseline is likely to be lower than last week because the impact of the expectations of slowing economy and then easing oil demand is going to gradually set in. So if you look at it, the renewed strike between US and Iran doesn't really, or has not, pop up the oil prices to above $100 per barrel. So I see that the expectation of slowing oil demand is setting in. And that's why I expect a lower baseline versus last week for this week. But of course, about the risk on the global oil prices, it's still towards, I will still gear towards the upward momentum. The short-term trend, the risk, maybe put it this way, the risk for the short-term global crude oil is biased to the upward momentum because of the current markets. But if you talk about the trend, the longer-term trend for the crude oil prices, because of the expected slowing down in crude oil demand because of the slowing economy, global economy, then this is biased to the downward momentum. But for our context, we are looking for this week. It's a very, very short term trading days, 5 trading days. So within these 5 trading days, the risk is still biased to the upward momentum. What I mean is that the probability of oil price going up for this week, the risk is still higher than the risk or the probability for the oil price coming off further, like below $80 per barrel, that kind of things. So this is my outlook for this week, the global oil prices. Now let's look at the gold price. For the gold price, the momentum is roughly the same, and the biasness is still towards the gold price coming down further, right, rather than going up. Because first of all, interest rates are going to stay high. In fact, there is no room for the central banks, various central banks, to cut interest rates significantly. So they are either to keep the interest rate at the current level, or they have to increase interest rates going forward, given the current high in inflation potentials. So because with this, holding gold gives you no interest. The only thing that you gain is the rise in gold price. But if you relocate the money on gold to, let's say, other US dollar assets, then for those assets, it gives you interest, like for example in US dollars, US treasuries, or now the bullish sentiments of the equities, especially in the US. Of course, whether it's bubbles, whether the tech bubble, and so on and so forth, that kind of risk there's another conversation. But given the current sentiment on equities, especially US equities, that is, you would have been better off putting money in US equities or US treasuries than to put your money in gold. So that's why the downward pressure on gold price is still there. Then, but the support for gold price at around $3,900 per ounce to $4,000 per ounce is still there. That means when gold prices reach that region, central banks, especially the China Central Bank, will come in and snap up gold and power up their gold portfolio. That will give support to the gold price. That's why if you see that, or you have seen that when gold prices hit that 3,900, or rather the around $4,000 per ounce, that level, that region, around that region, up and down, plus minus, you see that the price will start to go up again. That means there is some buying interest when the gold price hit the level. So for this week, I should continue to see that support will come in at the level. So, but the thing is, how should I say, the overall for the gold price is still biased to the downward momentum. Very unlikely that the gold price will fly and hit higher. It's not going to happen for this week. This is my assessment for the current Middle East situations, the oil price and the coal price for this week. That's all for this video. Thank you for watching. See you in the next one. Cheers.